Bloomberg Audio Studios. Podcasts, radio, news. This is the Bloomberg Surveillance Podcast. Catch us live weekdays at 7 a.m. Eastern on Apple CarPlay or Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Inflation coming up here in 4 minutes. Michael Barr on deck, but first, Jim Caron joins us from Morgan Stanley. The note is brilliant. We protect the copyright of all of our guests. Get Jim Caron's brilliance from Morgan Stanley. Okay, so you're out at aeronautical engineering at Caltech. In the final trick question on the exam sophomore year, Jim Caron, is what does it mean if the bond markets worry, hand-wringing worry, and Google can do a 100-year bond 9 times oversubscribed? Jim, I've never seen this.
Well, I think it's really a statement on the dispersion that's in the markets right now. So look, there's a lot of volatility that's happening, right? We understand what's happening in the equity markets, but then when we look at the publicly traded fixed income markets, as you're pointing out, the risk isn't necessarily being evenly distributed across all markets. And Tom, that's good news, okay? Because whenever we go into these types of market events where there's a big repricing in a certain sector, in this case it's software, the number one question is always about contagion. Is there contagion into other markets? And we're seeing fire breaks between the public markets and the private markets, and certainly equities are taking the brunt of this in some way, but we're not seeing broad-based contagion. So I think if there's a silver lining around all of this, I think that's it.
Jim, what do you make about this rotation we've seen out of some higher growth areas, most notably software, into, I don't know, more value parts of the market, maybe even to small and mid caps? That spooked a lot of folks who thought software and tech broadly was a good place to be.
Well, it's a great example of why you want to have a diversified portfolio, right? So we've come off of a market over the past couple of years that's been highly concentrated. Mag 7, Mag 7, Mag 7. And people just forgot about the other 493, right, in the S&P 500. And the point here is that if we get this rise in economic growth, this higher productivity, there should be a cyclical broadening of the markets. Look at the ISM data. ISMs are well above 50 right now. Even new orders are around 57. You've got the manufacturing above 52. You've got GDP growth, which is still pretty reasonable. Jobs, market seems pretty stable. Let's keep our eye on the bigger picture. And the reality here is that I do think that the cyclical broadening of the markets is actually really a healthy sign for more diversified growth. When
you listen to your economics team, is the vector in goods inflation? Usually it's a disinflation, and all of a sudden in the last 6 months, Jim Caron, I got goods inflation and rising inflation. Is that going to reverse and get back to quote unquote normal?
No, I don't think it will. I think that we have gone through a period of time, and this goes back to 2001 when China joined the WTO, that goods inflation was relatively flat to down.
Yeah.
And it was all about services inflation and everything else. So therefore, overall inflation was able to stay low. Now we're in a different place.
Should we get Jim Caron into trouble this morning?
Oh, yeah, absolutely.
Do you agree with the Posen-Orzag thesis of 4% inflation?
I do not. I think the number is probably around 2.5 to 3.
Yeah.
I think that's likely where we're going to stabilize. I don't think we're going to see below 2 for a while unless we see a recession.
That's brilliant. See how he did that?
He avoided that nicely.
He's so trained by compliance. I mean, he just absolutely nailed it. Adam posted out on Twitter this morning, recapitulating how we get to that worry of higher inflation. The release, you will, the reaction function is through maybe a higher wage, which we really haven't seen yet. Well, that's a bet. That's an outlier, as many people have said to us. Jim Caron with us, and will stay with us with Morgan Stanley Investment Management as we go to the nation's inflation report, usually midweek. It's on a Friday because of that brief government shutdown as well. We'll give you the headline data, folks, but then we dive into it and give you the nuance as we can on Bloomberg through the morning. Jim Caron with this Morgan Stanley. I go to a weaker dollar out there, but some real churn in the market as well. And we see it in Jim Caron's space, as they say.
Yep.
In the bond market, Jim Caron with a 10-year yield 4.07% with a substantial move over the last 2-3 days. Can you at Morgan Stanley model a 3.99% 10-year yield?
Well, I mean, it's certainly lower than what we would have expected it to be. It's really a question in terms of how we think the Fed starts to react to this. Does the Fed now start to see a clear runway to cutting rates maybe more aggressively because inflation, as we just saw, is maybe coming down a bit, maybe a bit faster than many people are expecting? I'm still in the camp that there's maybe one more cut this year, possibly two. So, and I think that's pretty much well in the price at this point, as far as where the 2-year Treasury is currently trading. And so I think it's going to be very difficult for the 10-year yield to stay below 4% for any material period of time, unless you believe there's going to be a significant flattening. And we don't. And we think the curve's going to stay relatively steep around, 60 basis points or so.
We welcome all of you across America. Bloomberg surveillance commercial free to the 9 o'clock hour. Michael Barr awaiting us as well. And Veronica Clark will join us from Citigroup here in a moment. Paul Sweeney with Morgan Stanley's Jim Caron.
Jim, this is a pretty eventful week for the Federal Reserve. Lots of data. It's a data-rich week. And I guess the takeaway is, boy, we got a pretty solid labor market. We saw that on Wednesday. And now we've got an inflation environment that continues to be pretty reasonable out there. Boy, the Fed could go either way here. They could sit on their hands or they could cut rates. How do you think they're going to interpret this week's data?
I think at the moment that they're probably still leaning towards potentially one more cut this year. If the inflation numbers are coming down, but we also have to understand that the unemployment rate did tick down from 4.4 to 4.3%.
Yep.
Now, could that be seasonal? Could that be an aberration? maybe we need to see a couple of more numbers, which is why I don't think the Fed's going to do anything, in the first quarter of this year, or probably they're going to have to wait until the second quarter, maybe late second quarter. So I think the way the Fed is likely to interpret this is that we have inflation that seems to be stabilizing. That's good news. A labor market that also seems to be stabilizing, but we need a little bit more confidence in that. You brought this point up earlier. What about wages, right? So, I think the big complaint out there, and I did a podcast on this, which was to make a $20 hamburger affordable again. And my point was that, the price of that hamburger is not likely coming down. What's going to make it more affordable is that incomes and wages need to start to go up, but they have to go up in a non-inflationary way. And the way that happens, this is the magic trick that the economy does, is through higher productivity. So higher productivity is the non-inflationary speed limit on growth, meaning that you can have higher wages, better growth, but that higher wages doesn't necessarily increase goods inflation or anything like that. That's what productivity does. Right now, the productivity numbers are accelerating higher.
Right.
So it is likely, if we get a recovery, that these incomes and wages can go up without creating the inflation, and that's what makes the $20 hamburger more affordable.
See how clear he does that?
It's not his
Do you
first
know
rodeo.
how we learned that? If you're at the Bowdoin Observatory in physics in February and it's 20 below zero and you get the telescope, it's clearer because it's cold air. That's how you get to think that clearly.
And then he says,
that bad.
And then he says, I got to get out to California
Was he
to technology.
Smart
Smart
out
move
to
there.
Caltech as well. Jim Caron, go write a report. He is brilliant at Morgan Stanley. We appreciate Mr. Caron's expertise here. I just can't say enough about his career, Chief Investment Officer, Portfolio Solutions, Morgan Stanley Investment Management. So Jim's there, and he doesn't have time, folks, to look at the terminal and to read this. Veronica Clark's going to join us in a bit with Citigroup. She's diving into the data. And, I mean, that's the way it is. Michael Ball's had a little bit of a chance to look as well. Bloomberg News macro strategist. Can you give us a service sector component yet, or goods component? Are you not there?
No, I mean, I'm taking a look. It looks nice compared to what we were expecting. Obviously, we all know January can often be a shock from prices resetting just normally. And then there's obviously the seasonality factors. And taking that aside, we're not seeing a whole lot of tariff pass through, which there was this concern that, after we'd sort of seen the dust settle, businesses would use January or the new year to basically reset higher. I'm looking at apparel, I'm looking at home furniture. Some of these things that we know would be in the crosshair there are not moving higher. Auto insurance is down. That's good. Obviously, shelter, big lower hit there, which is going to drag the whole thing down, which is very positive. And finally, I think it's coming from hospital services there. I see that is sticking out a little bit. And look, that is not cyclical.
Yep. If you're the Fed, I mean, pretty darn good week for you, right? I mean, if you're the administration, a good week. You feel like the things are working in the right way. But if you're the Fed with a dual mandate here, I'm in pretty good shape here.
Markets are pricing in a half a cut. So we're at 2.5 cuts for the year now on this.
2.5 cuts.
Yeah.
Okay, so what do you think? What are the variables going forward, do you think, for this?
Again, I think we have to watch these labor revisions, as we know. Yeah. The worry is that, one, the actual labor for January was not very cyclical. It was also structural, again, with what we're seeing in the CPI. So there is a structural story about the aging demographics of this nation. And that itself is not something the Fed can really target, but it is going to be a drag on overall growth. So we need to get ahead of that as far as the conversation. They need to sort of identify how they're thinking about it.
Red and green in the screen, we were very negative. Then we had a real recovery to a pop of decent green. Now -3 on futures. Small caps give me a little bit of green love now, but the VIX comes in. It was almost a 22. Now 20.86. The bond market is where we see some action. We got to a 4.06 on the 10-year yield. Now 4.08. Backs up a little bit off of it. Critically, I'm eating my Greek yogurt muffin.
I know
from
you've
Lisa
been all
Mateo.
over that. Thank you, Lisa.
I'm on my third one. Leave me alone. The 10-year real yield, 1.77%, speaks volumes to me. What's your mystery right now? You're going to write. I know you don't work the weekend. Did you know we're off Monday?
Yeah.
I had no idea.
I know this because I have a kid who will be home.
You have a kid that'll be. I'm sorry. It's February 12th. It's Lincoln's birthday. 22nd is Washington's birthday. 16th is a non-holiday.
I don't know.
I'll be here. Michael, what are you going to write about this weekend?
Well, I'm going to think about how we have to still discuss this price level versus change in price. And I think that's been a big theme where, again, we're all very conscious of, and you guys were speaking to it earlier, you go out, you see it in your face. And again, here I'm looking at the CPI report, food away from home barely went up, 0.2 here. Energy, we all had bigger bills from the winter, barely went up here in this. So is there really a disconnect, again, from this data to what is being experienced by the consumer? And hence we have to be careful saying, all right, well, inflation's beaten. But the consumer itself is still feeling it. It's feeling it from the levels, and it's also seeing a little bit different of a basket than what we're officially getting.
Don't you take a 3-month moving average?
You can, and I think that's all what's going down. And the 6-month average is even more encouraging. And I think when you hear from Myrons of the world and these kind of Fed guys that are more dovish, that's what they're looking at, the trend.
You know, in the labor market, people are concerned that it's really just being focused on healthcare and it's not a broad growth. But Peter Cheer of Academy Securities came out with a good point saying the good news is, or maybe the silver lining is, it wasn't government payrolls growing. Those actually declined a little bit. Thank you, Doge. So any job gains are in the private market. So at least that's better than just adding on to the bloat of the federal government.
Right, and you guys were talking about Adam Posen earlier. He did a good one on Odd Lots, speaking to the effects of Doge being sort of unevenly hit by certain demographics. What I would also take comfort in, and this may just be the AI build-out, is that the construction worker numbers were positive. Although manufacturing itself was relatively flat at 5,000, construction had 30. That's like a good sign. I mean, we obviously know that's not coming from the residential pulse, and we obviously saw the housing data for January, which was weather affected, being negative. But overall, we're not seeing a rollover there. And with what's going on in the immigration story, we still want to see construction jobs being added.
Can you stay with us?
Yes.
I mean, did you see what they have Eggs Benedict today up in the food?
Is that right?
Yeah,
Solid.
I thought Michael was heading out. Michael Ball with us with Bloomberg News, and he'll stay with us. Can we talk to someone smarter than you?
Yes.
Veronica Clark, folks, home run, nailed the jobs report. Andrew Hollenhurst turned to Veronica Clark and said, UNC beat Duke. Veronica, what's Jobs Day going to be? She nailed it with 135,000 estimate. How did you get there, Veronica? How did you guys get to way away from consensus? How did you do that?
Yeah, I was just feeling really good after this weekend. Yeah, yeah, it is. So I wouldn't read too much into that strength. The reason we were expecting that 135,000, obviously saw the number very close to that, is this really clear residual seasonal pattern that we see in a lot of data, and especially in the jobs data, especially in the inflation data too. That has meant stronger job growth in January. Usually what happens in January is you get this big decline in employment. When hiring is already low and firing is already low, that decline is less than usual, and the seasonal adjustment is too positive.
Right.
So I would take that stronger number with a bit of caution.
Okay, that's total nerd patrol. Combine the jobs report Wednesday, the CPI report Friday. What's it mean for Chairman Powell? What's it mean for Chairman Warsh?
Yeah, in all of this data this week, there's really nothing to change Chair Powell's view. I think that maybe there's some labor market stability. Again, I would be really cautious with this January data. I actually don't think there's a whole lot of labor market stability, but there's nothing really in any of this to change their view of rates on hold for now. But I do think this is, in terms of their dual mandate, a labor market that's moving in the wrong direction and inflation that's moving in the right direction. And I do think they'll be cutting later this year. Maybe we do get more of those cuts as we get to the summer with the new chair. And that's when the labor market data have weakened again the last couple of years. We would expect that again this year.
Veronica, you put together the data we saw this week in terms of a pretty full employed economy, one now with modest inflation out there. This has got to bode well for the U.S. consumer. How do you view the consumer these days?
Yeah, we've just had this surprising resilience to consumption for a number of years now, despite the labor market that is still very gradually weakening. Right, we have had on average a couple tenths of an increase in the unemployment rate each year, but yeah, consumption has just been surprisingly resilient. We did have retail sales data earlier this week that was softer. It's always hard to seasonally adjust that around the holidays. Maybe as we get January data, we have some winter storm disruptions too. But I think the expectation is that if this is just a gradually weakening labor market,
right,
yeah, people will probably keep spending. But I would worry that more and more people are worried about their job prospects. We see that in the consumer confidence data. Maybe you do cut back on spending a bit more at some point.
Veronica Clark, Citigroup with us, and Michael Ball of Bloomberg News with his work in macroeconomics, his tour of duty at the Fed. We're going to continue with Veronica Clark and Michael Ball. We say good morning to all of you, commercial free to 9 o'clock with the support of Interactive Brokers. Bloomberg Surveillance is brought to you by IBKR. Will the year-over-year change in the U.S. CPI, will it exceed next month 2.6% in February? Turn your view into a trade at ibkr.com/forecast. Last trading day leaps out to March 11th. And we thank Interactive Brokers for their support. Michael Ball, David Rosenberg was iconic at Merrill Lynch in saying, okay, and I say this, folks, I go, beneath the headline data. Baloney. Guys like you and Veronica Clark, Michael Ball, are looking at 50, 60, 70 items. The headline here is firmer services costs from our market to cut. Is that what we saw?
Look, I think I'm having a little trouble sometimes now because you have to put everything again to overuse term decay economy. So when I see airfares here rising 6.5%, but we're hearing from the airlines that they have this bifurcated experience with upper income people spending, the clubs are doing well, the cards are doing well, but the lower economy class people are struggling and they can't pass prices on. Like, what does this number really mean then? Because again, we have 20% seem to be doing just fine, pushing the envelope, and then 80% who are more price sensitive and value orientated. And this is not really showing up again as cleanly because this data can't capture that as cleanly.
We turn to Surveillance Caribbean correspondent Paul Sweeney here. How about Aruba? It was packed, right?
Aruba was packed. The flight down and back was packed. The restaurants were packed. It's one happy island. Everybody was happy
Alexis,
down there.
do we thank Paul for that report?
Oh, of course. You should always call in.
Absolutely.
Whenever on vacation, anywhere in the world.
He was at the gun turret looking at Venezuela. Was like 10 miles away.
Right there, exactly. And I'm just glad my fishing boat wasn't bombed, so we had a safe fishing trip. Veronica, talk to us here about the 30% of the economy, which is manufacturing. It had been in contraction for such a long period of time. I know it just doesn't get the love that the consumer does because the consumer is so much bigger. What's going on in Middle America with our manufacturing economy?
Yeah, it's been an interesting story. I mean, we've obviously seen, payroll job losses in manufacturing for a while. We did see some stronger job growth in January, but again, would caution to read too much into it. But it does predate this year. So, there are maybe some headwinds from tariffs, but it started before tariffs. Manufacturing is going to be a more rate sensitive sector. If you were looking, for evidence that maybe restrictive rates are weighing on hiring, that could be evidence of that. Yeah.
Michael Ball out front of Mark Niquette writing this up. Higher prices for airline fares, personal care, recreation, whatever that is, medical care, etc. Veronica Clark, we're all enjoying a new utility bill. How does that fold into next month's report? If I'm going to do with IBKR Forecast Trader, I guess, how does a utility bill that we're getting coming in, how's that going to affect inflation?
Yeah, I mean, it certainly should affect headline inflation. When we had these winter storms end of January, we saw natural gas prices spiking. That does tend to feed into consumer costs with about a month lag. So yeah, that February headline inflation reading certainly could look stronger. I mean, there have been, electricity costs, weaker dollar, obviously tariffs and higher commodity prices and everything, reasons to think that there's maybe some more goods price pressure in the pipeline. But I think the most important, underlying detail for the Fed is going to be various services. And yeah, we still see services that are a bit strong in this report, but that's pretty much expected. That's what we have seen the last few January, February months. And this is actually a bit less than what we've seen the last couple of years. We also see substantial slowing in shelter inflation, which is a really important part of the story, I think. And so that underlying pressure in services is not quite there. And if the labor market is weakening, loosening still, then even if you're seeing stronger goods prices, this does not become a pandemic type inflation issue, which also started in goods, if you have a weakening labor market.
Michael, we've seen rates kind of back up here. I'm just looking at the 2-year at 3.44, the 10-year at 4.08. Is the bond market telling the Fed, we got you covered? You don't need to cut. We're bringing rates down here. We see what's going on. I mean, I always feel like the bond market's ahead of everybody.
Yeah, I feel like the bond market this week's really been about the equity market and just the violence of this factor rotation. I mean, yesterday was pivotal, and that 30-year auction was the best we've seen in almost a decade.
Is that right? Wow.
Just the way it came through in the indirect bid.
Oh.
So I think, you just had a broader de-risking yesterday. There was also crash sort of in the commodity space as we thought algos, sort of CTA programs kind of got a sell trigger and they all rushed for that ore. So that spooked people as well, which supported sort of the 30-year auction because it came right before it. It's tough to say if the Fed's going to take comfort from financial conditions loosening on the long end here, given that a lot of them are happy with where policy is and talking about, basically this is where they want it. So again, there's a divided camp at the Fed and they're all reading things differently.
Veronica, congratulations on your non-farm payroll call. Folks, I make jokes about it, but I can't tell you the exceptionalism of nailing a non-farm payrolls report. How are you going to do it again next month? What will you study?
Probably not. Yeah, it is such a shot in the dark. Payrolls is probably one of the hardest things to forecast. It's just the first real hard data we get for that reference month. I am very conscious of this seasonal pattern, though, in the data.
Right.
It's been pretty consistent that really from like September through February, we get stronger data. That's a very low hiring time of year,
Veronica,
and then it weakens in the summer.
I don't care. Trimble of UNC. He's been there 4 years. That's the coolest thing in basketball.
It was amazing. Season. Yeah. It was pretty great to watch.
And he's like an adult. He's been there 4 years. Is that right,
that was good. Yeah. Now, unfortunately for UNC, their best player, Caleb Foster, injured. So hopefully they can get him back.
Veronica, were you there for 4 years or did you leave after 1 year?
I was there for 4 years.
She didn't turn pro early.
Veronica Clark, thank you so much. From Chapel Hill and from Citigroup, she and Hollandhorst killing it on non-farm payrolls. Stay with us. More from Bloomberg Surveillance coming up after this.
You're listening to the Bloomberg Surveillance Podcast. Catch us live weekday afternoons from 7 to 10 a.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
Isabelle Mateos y Lago held court at BlackRock for a good amount of time with Philip Hildenbrand, and she is now driving the ship at the hugely prestigious BNP Paribas Paris. They are definitive over 20, 30, 40 years in the calculation of economic growth. She is their group chief economist and joins us this morning. Isabelle, it's been way too long since we've spoken, and just wonderful to get an update with you. I'm surprised in your research note, it's your optimism on the resilience of economic growth. Discuss that.
Good morning, Tom, and thanks for the kind words here. I mean, look, it's true across the board. You talked about a European perspective, but growth has been resilient everywhere in the US, Europe, emerging markets, you name it. And our base case is that this is going to continue into 2026. And that's because you're seeing an investment surge, mostly in AI in the US, to a great extent in defense, but also in AI in Europe. And that's a very global supply chain, and that's powering still strong trade growth around the world. And so, yes, the outlook is pretty comfortable.
Your work at the IMF, I mean, you were steeped in this. I love this. Ready? The Global Spillover Report. Sounds like my checking account. Isabelle, you're so steeped in the international economics. How do you take right now this tech worry in America, this OMG, Isabelle Mateos is wrong about AI technology? How do you distill that on this Friday?
So I think there are some healthy elements to it, in the sense that throughout last year, you had a sense that there was indiscriminate enthusiasm for everything with AI in the name, in whatever part of the supply chain. And the question I got the most frequently in any meeting was, is there an AI bubble? And what you've been seeing in recent weeks is markets and investors asking themselves more questions before buying. And so there's been a bit of a rotation in terms of which part of the markets gets questioned the most. But my sense is so far that's been orderly and not an unhealthy development, because it's becoming very clear there are going to be winners and losers from this AI rollout, and continuing like we were in 2025 as if there would only going to be winners, that was probably not sustainable. So I take the recent market developments as more of a pause that refreshes and probably allows the leaning into AI, which we're seeing absolutely everywhere, to continue on a more healthy and sustainable basis.
Isabelle, 2025 was characterized in part due to tariffs, trade uncertainty throughout the globe. And even today, we're getting some news that President Trump and the trade team is working to narrow some of the scope of the metals tariffs. So it just seems to be a continued level of uncertainty about global trade. How has that impacted your economic outlook? It seems like most of the economies have kind of powered through it.
That's exactly right. And in fact, all the modeling that was done early last year around the impact of a global trade war or a tariff shock assumed that there would be a significant negative impact, and the bulk of that would come from uncertainty, leading to people being on hold, not investing, not consuming. And in fact, what we found was that there were offsetting factors which overrode really that uncertainty. One of these offsetting factors was monetary policy easing. Another offsetting factor was a big fiscal boost in Germany and in a few other countries as well. And another offset was this decision made synchronously by a number of corporates to lean in heavily into AI. And that really bolstered trade and activity around the world. And so when you look at, again, what's going to happen this year, we're only talking of further liberalization. Frankly, there's been much less talk of putting up new tariffs. There's been a flurry of new trade deals being signed, being negotiated. That's going to continue into 2026. And now even the White House is talking of lowering some of the tariffs imposed last year. So I would say, yes, we're not out of the uncertainty. Of course, we're also still expecting a ruling from the U.S. Supreme Court on the IEEPA tariffs. So by no means has the landscape on tariffs settled down. But I would say what we've learned from last year is that corporates can deal with this uncertainty and carry on with their investment plans and spending plans regardless.
Isabelle, we've seen last year with some of the trade uncertainty and the tariffs, Europe really step up here, particularly Germany, as you mentioned, and maybe several other countries, in terms of spending on defense, infrastructure, those types of things. Are we actually seeing that in the numbers yet?
So that's really interesting because the German fiscal boost was quantitatively the biggest, both in level and in quantum of change. But of course, that fiscal package only got voted in September, and so we are beginning to see it in the data. But it's literally in the last couple of months of data. But when you look at industrial production, the most recent data, and more importantly, the order books in Germany and around Europe, these are the strongest numbers that we've seen in a very long time. So, and it's only the beginning.
I want to do this, Paul, just so I can butcher my French. Isabelle loves the way I crush French.
Oh, yeah.
She and Lagarde used to laugh at me down at IMF. It sounds like something out of a Pink Panther movie. She was the Inspectrice des Finances.
Oh, boy.
For the French government. I mean, she's got serious credibility across France. Isabelle, an open question here, and with great respect for Thierry Breton, who was so supportive of me years ago. Why can't the French get technology right? That you have Sciences Po, you have the magical École system, you have 500 years of Cartesian mathematics in all. Why can't Paris, or I'll let you decide, Grenoble, why can't it be Silicon Valley? Why can't the French do technology?
So I'm not sure I would agree with you that the French can't do technology. There are some great tech companies here in France. And actually, when you look at what's been supporting the growth of the manufacturing sector in France, so you've got aeronautics on one side, but the rest is technology, is high-end technology. And France is actually benefiting from the modernization and the leaning into technology investment in the rest of Europe. So I think you're being a little unfair here.
Okay. Also, Paul needs hotel reservations.
Right, exactly.
April 15th. Work on that with BNP Paribas. Isabelle Mateos y Lago with us. Folks, I can't say enough about the arc of her young career here, driving all of economics at the French bank, BNP Paribas. Isabelle, thank you so much this morning. Stay with us. More from Bloomberg Surveillance coming up after this.
You're listening to the Bloomberg Surveillance Podcast. Catch us live weekday afternoons from 7 to 10 a.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
So my day starts, folks, wicked early. I read 12 newspapers like wicked early in the morning. It's what you need to do to get the zeitgeist on. Like the FT with this tariffs metal story.
Sure.
Like, folks, it's not even on our radar. I'm worried about pitchers and catchers. And I'm sorry, the tariffs seem to be coming in once again. So I grabbed this at like early this morning because Robert Teeter's with us with Silvercrest. This guy's great. Michael Batnick is just wonderful on the equity markets and, invest in all that. He calls it a wild market. I'm grabbing this again from Mr. Batnick. Over the last 8 sessions, 115 of the 500 S&P 500 stocks have declined 7% or more. The average drawdown is typically 34%, and we're only down 1.5%. Discuss.
Yeah, it's a great observation. I saw that chart as well. Fascinating. I think it speaks to where we are with markets. You have a solid foundation as far as the economy, but with where valuations are, markets are really struggling to find a new narrative here. The one thing I take a little solace in is that you're getting some rotation. You are seeing strength in some parts of the market. It's not indiscriminate selling. But it is a very powerful and very fast rotation from the winners of the past few years into some new areas. And so I think that chart really speaks to the point that this rotation is happening quickly. And it speaks to the fear that comes alongside having high valuations with a change in story.
Historically, rotations, how long do they last typically? Like here, we're rotating out of some high growth, maybe some techie names into some more industrial, maybe small and mid cap. Is that a short-term trade measured in quarters, or could it be something longer?
I think it could be something longer. One of the things that I think is making people a little jittery here is that it's happening so fast and so powerfully. The counter to that is that it doesn't take a lot to move some of these areas that have been underloved. So we put together this matrix and thought about, what happens if AI works or doesn't work and the economy stays strong or weak? People start to rebalance a little bit. It doesn't take a lot of rebalancing dollars to improve some of those areas that have been winning. So I think the part people are worried about is the speed with which money's coming out of some of the winners. We've looked back in the past. First phase is usually short covering. Once you get moves like this, as the chart spoke to, people start to pay attention, and then the reallocations flow. Right. It can last a while.
Paul Sweeney taught me this, folks. It's a WEI screen. First of all, is there a whisper number on inflation?
There might be. I have to check it out on the WEI.
Okay, so I'm looking at WEI. 1 year trailing, Dow up 11%, SPX up 12%, NASDAQ all-in composite up 13%. Come on, Paul, it's a double-digit look back.
It is. It's a double. And so one of the questions, Robert, has been U.S. versus non-U.S. I mean, if you look at 2025, the U.S. equity markets had a very good return, but a lot of international markets did a lot better than the U.S., and that's continuing into this year. So maybe another little part of that rotation is geographic rotation. How do you think about that?
Yeah, absolutely. Initially, I had thought that the move at the beginning of last year was sort of a one-off, but there's been a lot of follow-through on that. And I think it really speaks to this reallocation trend. If you look back at the big returns and how much the U.S. exceeded returns of non-U.S. and how much large cap exceeded small cap, there is room for rebalancing here. So I don't think it's necessarily something to get overly concerned about. A lot of these moves can be supported by people just getting back to target and offsetting and rebalancing some of those dispersion and gains that we've seen in the past few years.
So what screens well for you guys these days? Because the world's a lot different. I mean, it's in terms of just in the last several months, some of the growthy names not rewarded as much as they have been in the past. So what screens well for you? Either industry, sector, factor? How do you guys think about that?
Yeah, absolutely. Our mega theme really has been the shift from the builders of AI to the users of AI. And just generically speaking, that tends to lend itself towards smaller companies, very careful stock selection, paying a lot of attention to who's increasing profit margins versus who's decreasing profit margins, and going where people are using that technology to cut costs and boost gains. Some of that's in the small cap space. Some of it's outside large cap mega tech.
Do you assume large cap mega tech rebounds? And not give me this, 2 week, 1 week thing. I mean, over a year, over 3 years, don't they just keep on going?
The underlying fundamentals are so strong that it's hard for me to believe that you have this decline continuing. So I expect sometime, between now and perhaps next quarter earnings, you start to get some stabilization around fundamentals. The thing that made me a little bit worried was last quarter and this quarter, you have great earnings announcements, market overall kind of flat, and you get that reallocation away.
They just issued 100-year Google piece, 9 times, 10 times oversubscribed. You and I, we've never seen that.
Yeah, very rare. And picking up on your point from earlier, it probably speaks to the fact that the part of the season we're in is not spring training, but a little later into the fall.
So when you do see some of these tech companies come to the market in much greater size than we've ever seen in the past, does that give you pause here? Or are you all in on this AI thing and said, bring it?
Yeah, so we've been trying to really encourage people to move to risk neutral versus benchmark. We do think there's going to be a lot of volatility.
What so it means God's name does that mean? It's Friday.
It's Friday. Speaking better terms here. So, if your long-term target is 60% equities, we moved to 60% last fall. Before that, we were overweight equities. We thought there was a long runway. We do think there will still be some growth here, but this rotation is keeping top-line S&P returns down, and we think some of that continues. So I'm not, I don't think there's any reason to be dramatically underweight large cap tech. The fundamentals are there. But with where valuations are, people are really calling into question the narrative and the second derivative on growth, and the fact that if you have CapEx increasing and profit margins decreasing, you do want to diversify. So for years, people were punished for being diversified. I think now you get rewarded for being diversified. Doesn't mean you abandon large cap tech.
Diversified more into fixed income? Is that and also an area? How are you thinking about fixed income?
Yeah, fixed income looks pretty attractive here, I think. While there are, there is a potential today, maybe we get an uptick on CPI, and who knows what happens on a daily basis. I think the path is lower for rates over time. You have a kind of squishy labor market, and you have a backdrop where inflation is, certainly above 2, but not a major problem. So you'll get some cuts this year, and that'll lead to 10-year lower. That's a good backdrop for fixed income. And those yields are still pretty decent.
But getting back to Bucknell Finance 101, the bottom line is we need a nominal GDP animal spirit. with this inflation report in 19 minutes, I mean, it's popping a 4% plus nominal. Am I wrong on that?
No, GDP's been quite strong, and I think will continue to be. There's been a lot of fuel thrown onto the fire in terms of, juicing the economy into this year. And so there's no surprise that GDP's remained strong.
One of the interns, they screwed this up. I got Isabelle Mateos y Lago in Paris and Robert Teeter in New York giving me way too much optimism.
Way too much.
Just
Robert, how did we hear more and more and more about alternative investments, whether it's the stuff we grew up with, private equity, hedge funds. Now there's private credit. Some people are pitching me timber. I don't know what's going on out there. So how do you guys think about alternatives?
Yeah, generally speaking, we think it makes sense for certain clients that can tolerate the illiquidity. I would say in this environment, this is not an environment necessarily to be adding to those sorts of things. For me, this is very much a keep it simple environment. Get back to your target on risk, stay liquid, stay diversified.
Can I give you a vignette on this?
Yes, absolutely.
This is one of my great memories, with all my respect for Mr. Correa and the Pioneer Group, 60 State Street, Boston. Good morning, 92.9 FM, Boston. I'm standing with John Cogan at Logan. We're getting our bags from some place that needed, a beach and, the Caribbean, whatever. And he and I were talking about the lumber investment that Pioneer Group made. I think it was in Russia, like they owned half of Siberia or something. Should that be in my IRA, Robert Teeter? I don't think so.
I think for most people, the answer is no. Again, especially in this environment.
Endowments? Would you tell Bucknell's endowment to buy lumber in Siberia?
We are big believers in eliminating some of the complexity. A lot of people do these things. They put them in small size. You spend half the meeting talking about a 5 basis point allocation.
Exactly.
What's the point? We're just very big believers in keep it simple.
What's the
focus on
haircut
the big
right now
pieces.
on private credit? Paul mentions private credit, private equity. Do you have in your head a markdown on private credit right now?
We've seen some numbers, and they've been not pretty in terms of the markdowns. For a lot of the private client base, things that are just simple, old school muni bonds, et cetera, compare pretty well.
Yeah.
A few years ago, there was a big divergence. There was a lot of opportunity set, but a lot of money's flown into that space. Returns have compressed.
Correct me, Paul. We saw that in the last 2-3 days. Somebody said it used to be a double-digit gross on private credit, and it's now single-digit returns.
Yeah, I mean,
they're not selling what they used to sell.
No, it's interesting. We are going to get the CPI data in 17 minutes here. The Fed, are you kind of baking in 1-2 rate cuts this year? Is that kind of in your background?
I'm baking in 2, and we have a lot of conversations with clients who look at the Fed and they immediately gravitate toward the political side of it. But I really think the more interesting point is, if you're on the Fed, you can make a pretty good case for either outcome, either staying put for a long time or cuts. And so I think we will get a couple cuts. They'll probably coincide with if we get a weak labor print along the way.
What kind of weak labor print? I'm thinking of Neil Sauce, the giant at Credit Suisse, and basic core min-max, what's called min-max theory. What's the labor data point you follow where you go to Chairman Warsh? Oops.
Yeah, I think if you get a negative payroll number, if you get a decline in the hires rate, which is the expansion of payrolls, that's been hovering around 3%. If that starts to dip, if you start to see weakness in wages, not keeping up with inflation, you might get some support there.
Okay. Isabelle Mateos y Lago just emailed. She says, you can go to Paris and she'll come to New York.
All right. Fantastic.
Robert Teeter, thank you so much. Appreciate it. With Silvercrest Asset Management. Stay with us. More from Bloomberg Surveillance coming up after this.
You're listening to the Bloomberg Surveillance Podcast. Catch us live weekday afternoons from 7 to 10 a.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app, or watch us live on YouTube.
Joining us now, Heidi Crebo-Rediker, Senior Fellow at Geoeconomics at the Council on Foreign Relations. Heidi, we have a heartbreaking story. Krishna Kara, Stephen Wickery, on Cuba is struggling to keep the lights on. Anne-Marie Horton's down in Venezuela right now. I'm worried about her. Heidi Crebo-Rediker, can Venezuela keep the lights on?
So I'm worried about Anne-Marie too. Good morning and thanks for having me on. I think a lot about, we all have to think a lot about Venezuela these days, but what I'm paying attention to is really how the U.S. has put itself in the middle of Venezuela and China's trade with Venezuela. China was obviously, China, Russia, Iran were the key supporters of Venezuela, and Venezuela was one of the key supporters of Cuba. So, when you look at the relationship between the U.S. and China, it's interesting that China is now feeling the chokehold of its oil deals with Venezuela, because we don't really have a lot of cards to play with China. And so the fact that we're actually restricting their, any access to Venezuelan oil, kind of like a giant anaconda around this economy, and taking over the control of energy assets. It's very interesting to see what China's response is going to be.
I like how you kind of say in your notes here, Heidi, China's real problem isn't oil, it's debt as it relates to Venezuela. What do you mean by that?
So, Beijing has about a $10 to $20 billion Venezuela debt problem, debt exposure, and most of it's structured as oil for loans. I think in terms of how it's not a major source of China's oil. It's about 4%. So this is painful, but not existential. But the debt, I think, given that they have these long-term contracts, then they do have this debt exposure. They're going to have to figure that out with the Trump administration, because I don't think that the Chinese are really looking to lose 10 to 20 billion in revenues.
And I know when President Trump initiated the operation to take Mr. Maduro and perhaps put in a more friendly government, it was Mr. Trump and the administration said, U.S. oil companies are going to go in there and invest and really make a lot of money in Venezuela. I'm not sure we heard that type of enthusiasm from the energy CEOs, because they've had some bad history in the past in Venezuela. How do you think U.S. oil companies or Western Europe oil companies are going to deal with Venezuela?
So, it's one thing to do an oil export quarantine and bring the full bearing of the U.S. military around, that chokehold on exports. But I think, you have governance that's really unresolved. You have Delcy Rodriguez, who's claiming legitimacy, but she's still, insisting Maduro is the real president. They don't have, I think for short-term kind of wildcatters, it's going to be an opportunity. But I think you need stable rules. You need long-term capital for to repair the infrastructure, and you need security. I think it's just not a secure place right now.
Heidi, we're going to talk about this in a minute. Let me squeeze this in. Our tariff percentages coming down. The zeitgeist this morning from the FT, from our Jenny Leonard, is metal tariffs are going to come in. Do you just presume that tariffs are going to be lower than we expect?
So, the tariff question is a moving, it's sort of a moving puzzle, because you have these IEEPA rulings outstanding. You have, different agreements that are being renegotiated, for example, with India. You have a lot of exemptions that are being given for, things that we actually need in the United States that we don't produce, that could be inflationary if we don't have if you have the tariffs remaining in place. So I think you will see tariffs come down, but I think it's still going to be a very bumpy ride to where we get to a landing zone where we have some stability.
Heidi, thank you so much. Heidi Crebo-Rediker.
This is the Bloomberg Surveillance Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 7 to 10 a.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.